I was visiting with a guy who interviewed me earlier today, who had interviewed me some time ago. And when he interviewed me, the price of silver was at $38 an ounce. And, he says, well, the silver price has doubled. And I said, well, that means from a speculator's point of view, it's precisely half as attractive. It's very difficult for people to get that through their heads. But the fact that silver has gone from $38 to $80 in a fairly short time means that a substantial part, by no means all, but a substantial part of the attractiveness of it is gone. Remember, too, that if you sell some and take some profits and it goes higher, making money is not the worst sin that you will ever commit. There's the perception in China that there are impending shortages, not merely of investment silver, but rather silver for industrial applications. At the same time that there's increasing concern among the Chinese citizenry as to the financial outlook for the renminbi. So there's increasing attraction to precious metals. The Chinese government has made no secret of the fact that they intend to impose excise taxes or sales taxes on physical precious metals purchases. I think some of what you're seeing in the gold and silver price in China reflects the fact that the Chinese logically would prefer not to pay tax on their savings. And so they're doing that. But I'm not aware of all of the factors that might go into the arbitrage. The silver market is in real flux now. We have a circumstance, too, where the LBMA and the European markets were structurally short. And the consequence of that is that the London overnight spot price was 4% higher than the U.S. spot price, which drained the COMEX and caused silver lease rates in the United States to go from 4% to 40%. So there's a lot of turmoil in the silver market. I will tell you that as far as I know, not industrial quantities, but wholesale quantities of silver, which is to say things like 400 ounce or even kilo products, are not in short supply. But retail products are in short supply.
Rick Rule says the silver market is very unstable right now. Chinese buyers are rushing to buy physical silver, and borrowing costs have jumped sharply. He says buying U.S. bonds at 4% makes no sense when money is losing value. Since silver already doubled, he suggests taking profits. He uses gains to buy property and still holds platinum and palladium for supply risks. Thanks for watching. Give a thumbs up and subscribe to Find Metals for the latest insights.
If you are one of those people who believe that the CPI is a reasonable measure of the deterioration of the purchasing power of the U.S. dollar, bonds are a good investment. If you believe, like I, that the real rate of deterioration of the U.S. dollar is measured by the gold price, or is at least 8% compounded, the idea that you would buy a U.S. 10-year Treasury yielding 4.1 or 4.2 in a currency where your purchasing power is declining by 8% compounded is felony stupid. What that yield curve represents is the fact that savers are not willing to subsidize the federal government anymore.
Yeah. Okay.
Pretty simple. I mean, the last time we talked about the bond vigilantes, Clinton was in office.
Yeah.
But what you're seeing is the market begin to reestablish control of interest rates. The Fed pushes money into the short term. The government refinances in the short term. In the long term, if they aren't willing to buy the long-term paper themselves, which is to say, if they're not willing to quantitatively ease, or in other phrases, counterfeit, they run some danger of holding a bond auction that doesn't clear, where the buyers don't show. And I can tell you that community bank stocks, which I follow, are cheap. I can't talk about the rest of the sectors, but since we were talking about a different asset class, I suspect that if you talk about many things priced in gold, they feel cheap.
Yeah.
Certainly rents expressed in gold are cheap. Health insurance measured in gold is cheap. Groceries measured in gold, cheap. What that really speaks to is not so much the aggregate value of the asset, but the deterioration of the purchasing power of the U.S. dollar relative to real money. And in particular for the S&P 500, normalizing the top 8 performers, which is to say the S&P 500 without the big techs, that you'd find that U.S. equities, ex the big techs probably represent a more dramatic valuation disparity in gold than houses do. On the side of houses is the fact that for housing, unlike almost any other asset class, a 25% down payment is considered generous. So rather than 5,000 ounces of silver, what you're really talking about is 1,250 to 1,500 ounces, provided that by buying the house, the rent that you charge or the rent that you forego covers the mortgage on that house.
Yeah.
The great attractiveness to me of residential real estate has always been that by using a conservative mortgage, a 75% first, that you can lock down your cost of capital for 30 years, fix your cost of capital for 30 years while your return on capital employed increases. In my life, earlier in my life, when I bought duplexes and triplexes, I usually, in fact, in every circumstance that I remember, was able to finance out after 5 years, which is to say the rent escalation and real estate appreciation meant that I could refinance after owning the home for 5 years, and I could withdraw all of the capital that I had invested while still having rents service the mortgage, a classical case of the point of no concern. The thing that bothers me a little bit about the housing market is that in many markets, the juxtaposition between the cost to own and the cost to rent is too high, and that rent prices are bumping into affordability ceilings. So you need to be very, very careful how you buy that home. You need to be careful not to overpay. And you also have to be concerned, particularly in a place like New York City, where the political class has decided that your house is their house, that you don't run into rent controls or other forms of confiscation and nationalization. I don't know if you listened to the new housing czar of New York City yesterday.
No.
But she basically said that New York City is going to revisit their relationship with property. When you come into periods of frenzy like this, to monetize. Let's say I sell some silver, and let's say the price goes from $80 to $100. But I made the move from $35 to $80. The fact that I made better than a double is not the worst sin I've ever committed in my speculative history. And I'm actually old enough that I don't care about money I leave on the table. I have absolutely no fear of missing out. I have a huge fear of making a mistake. Well, Venezuela's a news trade. He's absolutely right. People who trade news over time lose money. That's a truism in investing. Let's talk about oil. Oil is in the near term oversupplied, not because of production surges, although the Saudis are producing a lot, probably as a political accommodation to Mr. Trump, but really as a consequence of weakness in demand, particularly Chinese demand. The market was bullish some time ago because they thought that a sales hiatus of Russian crude would impact global markets. But there hasn't been a hiatus in Russian crude. It's just that Russian crude became Indian crude somehow, although India doesn't produce oil. So that shortage didn't occur. But looking longer term, you don't need to look much longer, 2 years, 3 years. I know that's an eternity to traders. But for rational people, 2 or 3 years is a very short period of time. The deferral of sustaining capital investments and the almost total lack of new project capital investments means that production rates on a global basis will be really challenged, probably beginning 2028, maybe beginning late 2027. To put that in perspective, the global industry is estimated to be underspending in terms of sustaining capital between $1 billion and $2 billion a day. And this bites you in the out years. In addition to that, the swing producer for the last 15 years has been the United States. We went from the biggest oil importer in the world to a big oil exporter as a consequence of technologies that enabled the monetization of oil that was tied up in shales. At $60 oil, at today's interest rates, the ability for the U.S. industry to make money full cycle, even recover their cost of capital at $60, is very, very, very challenged. One of the reasons why I own so much physical platinum and palladium is, first of all, because it was too cheap. It was under-owned. But also because I think there's a possibility, not a probability, but a possibility that you have a 20 or 30% supply disruption from either South Africa or Russia. And if that happens, that chart that you see is child's play. I'm not saying it's going to happen, but if it does happen, you see a double or a triple from these levels. What you're seeing reflected in that price, in the copper price, is the fact that in 2025, the copper market was already in structural deficit, meaning that we were using up prior year's inventories, that new mine production and recycling was not equaling demand. And then in 2025, approximately 7% of the world's copper production came offline. I would have expected the response of the copper market to be more dramatic than it's been. That being said, I think the fairly tempered response that we've seen is a function of the fact that demand is much weaker than people assume it is. And that probably means in the very, very near term that the physical copper market has some risk to the downside. Again, as I said from silver, the fact that the silver price vaulted from $38 to $80 means from a speculative point of view, it's half as attractive as it was. Silver at $6 is less attractive in the near term than it was at $5. Every 90 days, we host an 8-hour-long deep dive into one topic around natural resource investing. It might be silver, it might be uranium. We did a 3-part on gold. This is the first time that we've done one that's regional. We did a regional boot camp because that's what our students asked us to do. We responded to the market, which I think is a smart thing to do. But it's a great subject for us for many reasons. First of all, exploration capital markets globally have a very strong Canadian component. Canada punches way above its weight in terms of exploration finance. And that means that the cost of capital to explore in Canada is lower than it does other places. That's a durable competitive advantage. The best place to explore for minerals in Western Canada, I believe, is the Golden Triangle in northern BC. The fact that the U.S. industry estimates that we've now drilled about 85% of the tier 1 locations at $60 oil, which is to say the production surge that's been generated, particularly by the Permian and the Eagle Ford, over the last 15 years is over at $60 oil. And that's important. Remember, too, that oil is a very capital-intensive business. It is very reflective of social rents, which is to say government theft, and also interest rates. And government theft is increasing around the world, and long interest rates are increasing, too. For the oil industry, that problem is coupled, too, by the politically incorrect nature of the oil business and the retreat of large capital suppliers, including Norges Bank, the biggest financial institution in the world, from the oil markets. The big banks in the United States that dominate oil and gas finance, I'm thinking in particular Citicorp and JP Morgan Chase, have restricted access to credit for some family offices I know that traditionally ran $150 or $200 million credit lines. There's no shortage of credit necessarily for Chevron or Exxon or Occidental, but for the mere humans, and these family offices with $200 million production credit facilities are superhuman. That constrained access to credit, even if they can still get credit,